Okay, we should be live and good to go. Let me know if you can hear me, see my screen. Normal audio-visual checks. Good evening, everyone. Nice to have you, as always. Once we've passed the basic test of audio-video, we'll get going. Not that there's any shortage of things to talk about. Nice to see familiar faces, as always. Peter never misses a day. Dumbo, Danny as well. And hello to everyone who's from the Casual Friday video. Hope that was enjoyable. I certainly enjoyed that session. If you haven't watched Casual Friday with Gainsey, I strongly recommend it. Just have it playing in the background. Some really good stuff there. Really good session, and the feedback has been positive as well, so thank you very much. We will look at YFI, Richard. Certainly take a look at that. Okay, let's get going. First things first, I'll try to keep the intro short because we've got a lot to talk about. Thank you to Bybit for sponsoring Technical Roundup. Monday is always fun because they sponsor this show, obviously, and then the next day is the newsletter. Link is in the description. Sign up to that. And then Wednesday is Donald's live stream. So plenty of content to get you started throughout the week. Thank you to them. Second of all, thank you so much for getting us over that 10K subscriber threshold. Planning to do something special. Don't know what that is yet, but by the forces of creativity, I'm sure we'll come up with something interesting. So thank you very much for the support there. And make sure to like this video with a simple click and subscribe if you haven't already. Those little cringe YouTube influencer things, which I repeat every live stream, do actually help and make a difference. So any support on that front would be greatly appreciated. Ring that bell, OnlyFans, Patreon, yeah, all that fun stuff. So with that out of the way, let's talk some markets. The title, as you can see, is Hints for Market Structure, but there's plenty of other stuff to talk about as well. We'll start with Bitcoin, as the last live stream, if memory serves correctly, was prior to the monthly close. As you can see from our levels, at least, let me just get rid of this line here, the last price line. Okay, so on a monthly basis, I don't know why that's got a circle. There we go. So on a monthly basis, the monthly close in terms of technicals was about as bullish as one could expect of a retest of this structure. Again, a lot of the time you'll notice that time frame bias creeps in when you're making analysis, that because price spends a lot of time somewhere, or a candle close takes longer on higher time frames than others, or the moves are bigger on higher time frames than others, etc., a lot of the time we risk losing sight of the technicals. So that's why candle closes are useful. I suppose that's another topic in itself. But even in the market that moves 24/7, this is the most common way that participants and certainly technical traders, or certainly a large portion of technical traders, will visualize the market. So I suppose there's an argument to be made about self-fulfilling prophecy, but more generally, without delving into kind of social psychology, conspiracy theory bullshit, candle closes are kind of a consensus form to decide whether a level on a given time frame has been broken or not. Right? Yes, crypto trades 24/7, but in that 24/7 period, we still need kind of time separators to let us know and inform us as to whether certain levels or prices have been broken, accepted above, below, etc. Right? So that's kind of a very short piece on why candle closes still matter on all sorts of time frames. Long story short, yes, self-fulfilling prophecy, etc., but it seems to be a reasonably well-accepted consensus mechanism for ascertaining whether a level has been, or area has been broken or not. Again, it's not perfect. That doesn't mean it leads to perfect signals or trades. You know, fake outs are still a thing. As we know from high time frames, those retests can often be uncomfortable, but we still have to deal with what's in front of us. So with that said, we're here on the monthly time frame, right? And for me and for us on the Monday sessions, monthly support has been characterized by two levels. Highest close, the kind of top of the range before the breakdown at 10.3, and the highest close at 10.7. And the monthly closed above the upper boundary at 10.7, having tested the lower boundary at 10.3. So that's about as bullish close as you can reasonably get, or at least a kind of firm, successful retest close as you can ask for. Again, the basic technical structure is quite straightforward. If I were to draw this on any other time frame, or even just a line chart diagram version, whereby you have a level, right? It acts as resistance, as it has done previously. You can see that just by, I suppose, looking at the chart in these instances here. Acts as resistance, then breaks above it, okay, as we had a couple months ago, or whenever that was. Comes back to test the level, right? In this case, you can see actually you kind of got two retests essentially, one of the upper boundary and then more recently of the lower boundary as well. So something like this, first month closes above the level having tested the upper boundary, but really in terms of structure, we're sort of, the wick is at the lows and then the close above the level. Now, if I were to draw this or this price action on an hourly time frame, you would have no issues, I suppose, coming to terms with the technicals, right? If this were an hourly level, you'd have level broken in 1 hour, market spends another hour above it, retested it in the third hour and closed above. That doesn't invalidate the level or cast doubt over the level or do anything like that. We're absolutely fine with a wick. You know, the technical structure in itself, regardless of time frame, is kind of fine, right? Or at least reasonably straightforward in terms of broken resistance showing evidence of support. But because we're dealing with the monthly time frame, and literally as much as I'd love for it to be an hour or 3 hour session, you know, break 1 hour, retest, blah, 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 we are indeed dealing with, you know, monthly close above, a full month of trading above it, and then another full month of retesting the level, going as low as sub 10K at the very wick. So again, it's important at these closes, anywhere from the daily time frame, but even to the monthly and weekly, to make sure to revisit the closes and see whether you were particularly bullish, bearish at the wick, or all of that type of stuff. Okay, so without spending too much time here, monthly directional bias is fine for this month. I'd argue it's bullish, just like we saw at the retest of 10.3. Just because you close above a level doesn't mean it doesn't get retested. So this month closed above. We spoke about this on stream, and we got the retest the subsequent month. And where we are right now, the only addition I will make to this current chart is I think it's worth delineating, given this context whereby we've had the break, we've had two retests. It's really time for the market to get moving one way or another if it's going to be bullish, certainly. One thing to add to one's charts is actually the monthly open, right? So for us, that would be here, comes out at 10,800 roughly. I'm just going to label that as the monthly open. And I suppose the point of doing that is that as lower time frame price action develops, we can kind of use that to paint or get some context on how the high time frame chart is forming. So once, let's say, price starts getting above the monthly open, you know, in the next week or whenever that may be, if at all, we can kind of start to have in our minds an idea of how the monthly chart itself looks, that this candle flipping from red to green after a retest of support. Okay, so basically momentum continuation or whatever it may be through the monthly open. Ideally a bit later in the month, not this early, but that's another topic in itself. That would be a pretty reasonable trigger, or at least how you'd expect the trade to develop should things play out as the monthly close suggests. And you can see it should come as no surprise that because of how we closed and where the retest happened, etc., where the monthly open landed should be on your charts anyway, or is likely to be on your charts, given it is confluent / aligned with the quarterly level at 10.7. So there's a lot going on in this area. What I will say as a final note about the monthly, again, don't want to spend too much time here, but it is important. And this is going to sound really weird and perhaps not terribly convincing at first sight, but the move from 10.3 / 10.7 hasn't really happened yet, right? So if we consider 10.3 to 10.7 being a key high time frame level, and I'm just going to draw it as a box because that's pretty acceptable when we're dealing with a $400 monthly range. So there really hasn't been a move from this level yet in either direction, right? If it's bullish, and we expect bullish continuation, the move would be a move towards, I mean, let's say previous month's high, or if we're taking a level to level approach, towards resistance at 14K. So that clearly hasn't happened because we're still glued to the level, and that's the bullish continuation scenario. The bearish continuation scenario, or I suppose the failed bullish breakout scenario, would be the opposite, right? That we closed above the level, broke it, everything looks rosy, but then it would entail the level failing and trading much lower because failed breakouts are generally bearish. And that would take price, I think, yeah, there are some sticking points around 9.6 and all of that on lower time frames. But if we're sticking to the monthly, bullish continuation to previous month's high and 14K, bullish failure, if you want to call it that, towards 8K. And given where we are right now, that's what I mean when I say that the move from this level, be it bullish or bearish, hasn't played out yet. Because the price, regardless of these wicks, which, you know, in real price terms, deviated a fair bit from the level, if we just look at price structure as a whole, how these candles are shaping around the level itself, fuck all has happened, really, right? We haven't reached very new levels. There's been no kind of volatility expansion towards upside or downside. We've kind of remained glued, and that's an important bit of context to consider. What we can do is reevaluate the evidence as the months and weeks go on and try to build a case towards continuation or failure. Monthly close is one of those things, one piece of the puzzle or piece of evidence when building that picture. Monthly close suggests bullish continuation, but obviously, as discussed on previous live streams, the monthly time frame simply moves too slowly for us to just trade that or to take, I suppose, binary signals from that time frame. So normally, especially in this context, you know, again, we've had a close above, you've had the retest, you've had another retest. Having spent so much time here, you really want to see evidence of continuation if this thing is going to set up. And the way we do that without having to wait every month for some sort of trade signal is by jumping down a time frame or two and looking for what I like to call, again, that sounds like I made that shit up. It's just an English word. Doesn't really not trying to give you the whole voodoo technical analysis. I made this type of thing. But time frame alignment, right? When lower time frames fall into alignment with higher time frame closes and basically give you further evidence that high time frame closes are going to play out. Right? So if you get a bearish daily close, alignment would be your intraday timeframes starting to look bearish, / rallies being sold, etc. And so all we're doing is kind of jumping a time frame. If the monthly is bullish, which the close suggests, we want to see evidence of that materializing on the weekly time frame and that having a trickle down effect on the daily time frame, etc., etc. Okay. Going to the weekly time frame, it's hard to have any strong views. And the reason for that is I think price had a pretty good chance to offer bullish continuation on the weekly time frame pretty much in the week before last. If we just take these quarterly and monthly levels and look at them on the weekly time frame, so that kind of exercise we spoke about moments ago, we were kind of stuck within the range and chopping at its boundaries, right? So closed below, didn't find resistance, went to the top of the range, okay? So technically bullish, but then look what's happened now. You've had closes at the range high, so weekly close is above 10.7, but last week's close was below it, and now we're finding resistance at the level. So choppy, to say the least. We certainly know from intraday charts and just the average rotation length and size and all of that type of stuff, and we will come to daily market structure, that we are just chopping between 10.3, 10.7 on a high time frame basis without a break of this high time frame range happening quite yet. Okay, so that type of alignment we talked about of monthly strength, we need the weekly and daily to step up and actually give us a move either up towards the next level or at least down towards the next level. Just no evidence of that yet. Market seems to be compressing, chopping, right? Big move coming soon and all that usual memery stuff, but unironically that is sort of what the technicals are suggesting, and the daily time frame is a decent way to look at that. Just by looking at market structure, if I were to just disappear these lines, I don't like using disappear as a verb, but here we are. The most basic indicator of volatility kind of cooling off, if we just draw these trend lines, we've got lower highs recently, but also higher lows recently. And we're approaching the apex of this triangle or consolidation pattern or range or whatever you want to call it. So again, you can see we're kind of building a picture where monthly is retesting quite a tight area, 10.3, 10.7. The weekly is showing an unwillingness to break that range, 10.3, 10.7. It kind of pokes at one side, reverts to the other, pokes at the other side, reverts to the original. That's kind of where we're capped. And the daily time frame should come as no surprise. It reflects those choppy conditions because we are just grinding sideways, making higher lows, which is bullish, yay, but also lower highs, which isn't bullish, less of a yay. So that's kind of the anatomy of chop, if I could use those terms. Before we get into the intraday timeframes and some trade ideas, etc., is that reasonably clear in terms of context for Bitcoin so far? Okay, The answer seems to be yes. I saw a good question from Peter Craig talking about candle closes. Do you ever consider line charts rather than candle charts? Depending on how your line chart is configured, as far as I'm aware, I could be wrong. I think the default, or one of the default settings, is to have it tailored to candle closes. And that's where most of my stuff comes from. I don't use wicks too often. So more often than not, my candlestick chart, because I use my open and closes as the anchors for my support resistance levels, they'll kind of fall in line with line chart highs and lows as well. So we all kind of end up in the same area. RJ says, you're still in your sister's house. Yes, I have had no internet at my house for over 2 weeks now. Isn't that amazing? Here's the level of commitment to these live streams and to the profession, eh? Although I'm telling you, not had much fun trading on this setup at all. Yeah, okay. So where do we go from here? Now, the obvious kind of LARPy crypto YouTube technical analysis thing is to pick a big level. So let's say 10.7 is like a big level. Or even if you want to be, really conservative about it, you just pick like the extreme of a range. Let's say this, and then I draw something like this. Well, look, if it breaks and goes really bullish, and then if it does something like this, it'll go up, and then therefore the market's bullish. Like, that's great, right? If a big level breaks, it'll go higher. If a big level breaks, it'll go lower. But that's not terribly useful for our purposes. I think it's useful to come up with trading plans like this to some extent, that you know where the key levels are and you know which direction to trade if they're broken. So providing that context is certainly a useful exercise, but expecting the chart to actually look so clean and so straightforward and give you such a nice entry should price trade at those levels is usually an exercise in futility and not a terribly efficient use of one's time. So I suppose that's a very kind of side note on trading plans / trading journals. I think doing the whole squiggly line, break and retest, all that sort of stuff, it serves a function, and that function should be to give you a directional bias or tell you which direction to trade a break and or a retest of a high time frame level. But that plan is different from expecting your execution to actually align and look exactly like this. Okay, so squiggly lines and all this diagrams, levels, etc., they should tell you where to trade and in what direction, but not exactly how to trade and how to execute. Because more often than not, the market will not give you such a clear opportunity to get on board. And if you're constantly sat waiting for your exact squiggly line to come to fruition before taking any sort of trade, you will miss out on most moves. Again, it looks good on Twitter, a lot of hindsight analysis and all this sort of stuff. Fantastic, but if we're in the trading business, we need to tailor our expectations and get used to some degree of uncertainty and discretionary decision making if your framework caters for that. And mine certainly does, and that's why in these live streams, I'll give you my levels. Certainly, I'll give you my rough plans, what I want to see, what I ideally want to see. But at the end of the day, I have to make the assessment then and there as to how the market looks, which side I want to take, and what's clear to me and risk defined at the time. Kind of like I said in that Twitter thread, no two setups are the same. So the best we can do is come up with guidelines, I believe. If you follow some framework that's reasonably analogous to mine, we can come up with, a rough plan, evidence of direction, the levels, but how exactly price unfolds, that's for the market to decide. And the best we can do is just to make an informed decision in the moment based on the macro plan, if you will. Okay, so with that said, what was I going to say? Yeah, I've added 2 levels to this chart. One is the trend line. Some of you may be totally aghast and surprised to see that. I've got nothing against trend lines. I think they work well, both in terms of identifying shifts in momentum, but also tradable as technical structures where it makes sense to do so. So I've just got this broken support trend line here from this intraday range, previous lows, and you can see it also aligns with our quarterly level at 10.7. So we've certainly got some confluence in that area. That's absolutely fine. And then the other level I've added, I think that comes from the hourly, is this gray box. Now this gray box is similar to what we talked about in either last session or the one before that. Those of you who remember one of the rants, not really rants, I suppose the side topics we talked about, we focused on what's one way to filter for levels that work well, right? What's the difference between like a good level, a great level? How do I know if there are certain, if there's a cluster of levels nearby and I'm just drawing support resistance everywhere on my chart? How do I remove that noise and focus on the stuff that matters? And one of the, I suppose, heuristics we arrived at is when you're trying to identify a level or an area or just a potential turning point in the market, one thing to filter for is how did this structure, be it a level, a consolidation, whatever it may be. Again, I distinguish to some extent between level and consolidation. Those of you who watched the Ethereum or Link video or just these live streams know that one of the technical structures I really like trading is when you get impulse move, consolidation, and then continuation in momentum. And it's really this consolidation that in itself becomes a valid technical structure, right? So that's not a level per se. It'll often align with higher time frame levels, but it's a slightly different structure, right? And where does this gray box come from? Well, yes, it is one such structure. If we just zoom in on it a little bit, you can pretty much see how, not the best example, but the second part of this will make slightly more sense. You kind of have a small leg down, but really this box or the consolidation is the origin of, or the source of, or it preceded, whatever terminology you want to use, doesn't matter, a large block of selling, right? This leg of selling occurred prior to or followed this consolidation that we've boxed out. Now, the question that springs to mind is, well, these boxes or these candles exist everywhere. So how do I know which ones to draw or delineate if I'm going to follow or map out these technical structures? And the answer ends up being quite simple. Those types of structures or boxes or areas are significant if they occurred around a market structure shift. Okay, so consolidations, ranges, levels, it applies to all your technical stuff. They gain a lot more power, in my view, or just they're much more reliable and have a lot more technical gravitas or weight if they occur around key points in market structure. So how does that apply to the present example? Well, you can see if we just look at this range, this consolidation, highest close, lowest close, for example, right? Let's just box out the whole thing here, right? Here's where we're looking. You can see that this was the consolidation that preceded this leg of selling. Sure, basic supply zone, whatever you want to call it. But more importantly, this block or this leg of selling that we talked about broke market structure, because it is this sell-off which led to, or formed is probably the best verb to use, a lower low, right? So you basically had reasonably equal highs and higher lows. Then you had this consolidation, and it immediately preceded the leg, which in itself is bearish, right? Wow, a lot of selling came from this supply zone, etc. But the context is more important, that it caused or led to a break in market structure, right? These previous lows here, this consolidation, and this pattern of higher lows was broken. So that's what makes it technically significant. And accordingly, price likes to come back to these areas and use them as support on pretty much any time frame. Now, a final point to consider is using these structures for directional bias. So forgetting all the price action that followed, like forget all of this with our focus still within the box. Technically, once market structure is broken, right? Once you get this leg of selling here, and you get a lower low and a break in structure after a fake out, no less, right? The gray box is technically resistance, right? A range, impulsive break of the range to the downside, so this is expected to be resistance. What did price action do instead? It came back into the range or into this level, paused just before testing it, and then the next level, the next candle completely smashes it. So that's the kind of flip in directional bias. To summarize all those thoughts, right? This consolidation, and again, this is a very specific box. It never should be that specific, in my opinion. You could just literally draw out the whole range that took place before the break in market structure. So lowest close, highest close, and literally use something like that. That's probably quite easy to visualize. That's pretty straightforward. This was the lowest close, highest close before a break in market structure. Again, very important. It's those market structure shifts which give significance to the levels, right? Market structure broke to the downside. We're technically bearish and expecting resistance in the red box. What does the market do? Comes in and completely smashes it and closes through it. That's bullish, and we now expect basically flip directional bias and expect the box to act as support, or this area to act as support, which it's done at the moment, right? So basically, it's like a failure to act or continue in the direction of the break-in market structure. Another really good example of that, or the inverse example, again, this is hindsight cherry picking, sure, but we're doing educational stuff anyway, so it doesn't really matter. This is a really good example and just generally works well in, choppy markets, sure. We take this bit of price action here. Specifically, you see you have a sequence of pretty much, higher lows here, and to some extent, lower highs, right? What happens after that? Well, market structure breaks to the upside. You've got lower high, lower high, lower high, and then you get this higher high here. So again, we're working backwards. We're trying to identify the consolidation which formed as close as possible to the break-in market structure. So in this instance, and again, these examples aren't perfect. They're not pre-prepared. I'm sure you can nitpick some exceptions, exclusions. I'm using this to demonstrate a point. So, it's for pedagogical purposes, I suppose. So here we are. It's this consolidation, right? Which preceded or came before. This is the range. Again, highest close, lowest close, or high and low, doesn't really matter. Before this high, which broke market structure, because it broke this sequence of lower highs. That's why the red box is there. That's why I chose it, because it is this consolidation here, this range, this highest close, lowest close, which preceded the shift from high, lower high, higher high. Holy shit, market structure broken. Where did that quote unquote come from? And we work backwards and find this consolidation, right? And then you can see these levels act pretty good or pretty well, pretty terrible English to say the least, as support or resistance. And therefore, when it fails to act as support, and certainly when you get impulsive sell-offs through it like that, you can reasonably expect the market to find some sort of technical significance at these levels on rounded retests. Kind of like in this example, so let me just remove the clutter and draw those two boxes. Again, lowest close, highest close before market structure nuked, okay? Lowest close, highest, let me just do highest close, lowest close, just easier for my touchpad. Highest close, lowest close before market structure broke out, and that's sort of why these areas, for me at least, end up being technically significant. And when they fail, right? So this is a bullish breakout. Oh my God, it should have acted as support. It failed, acts as resistance. And then on a rounded retest is where the market certainly likes to find the easier trade entry / reaction, right? Bullish breakout, eats shit. Bullish breakout, eating shit is bearish. Resistance, resistance. Bearish breakdown, eats shit. Bearish breakdown, failing is bullish. Find support, find support. Did that make sense to anybody at all? If you learned something, let's get to 100 likes. Wink, wink, nudge, nudge. Again, it's not perfect. It's much easier done on higher time frames, in my opinion. But if you're really looking for... if you're really shit at picking levels and you seem to just completely mash in the middle of nowhere and draw every support, resistance, etc., looking for levels or structures or ranges, boxes, right? Take your pick, where market structure shifted is pretty good way to filter out a lot of that bullshit. So let's look at that on the daily time frame, just as an example, right? Sorry, my bad. What I want to know on the daily time frame is to discuss where the market is right now, because we've been doing edumacation for half the stream. Basically, the high time frame context is the same as mentioned towards the beginning, that we're in high time frame chop, moving between 10.3, 10.7. This is the point where I drew those two trend lines, right? Or those two kind of market structure lines, whatever you want to call them. We're basically making lower highs and higher lows, and volatility is kind of falling off, chopping, and, whatever, moving sideways. It's really at points like this where you can make valid arguments for both sides without either being terribly clear, right? So you can say, for example, well, look, you had all this bearish news and all the market's done is essentially creep up and make higher lows. That's bullish. Well, okay, well, that's valid, right? That argument is reasonably compelling, sure, or at least there's nothing terribly wrong with it. But on the flip side, you can say, well, look, we have this monthly resistance at 10.7. We had a break of the level, closed above, failed quite spectacularly on this engulfing candle, and is now acting as resistance as well. So someone points to the higher lows, they point to the lower highs, they point to whatever support creeping up, they point to resistance creeping down. I don't think there's, at a certain point, you either have to bet which way it's going to resolve, or try to trade the quote-unquote confirmation of the move, which is always way harder, right? For me personally, around these levels, there are two setups that I'm kind of looking for on the daily time frame. And again, they may translate to intraday trades and all this usual stuff, but just to get the structure across. The first one is the kind of Donald special, if you will. I think he's got this red candle, this consolidation marked out. Still acting as resistance, something we covered in the previous stream as well. So the simple idea would be a break through this structure, and then either any pullback into support. I know I'm doing now, what I criticized at the beginning of the live stream, but again, the best I can do is to give my own rough roadmaps, approximations, or kind of templates for how I want to trade this, and what the market decides to do with that, and how it looks when this is actually happening is a different thing entirely, right? So take it with a whole bag of salt. So either, more or less, a break of the red structure into any sort of retest higher, or a break of the structure into a consolidation, and then some sort of lower time frame trigger into continuation higher. That's kind of the conservative one. We know this level is resistance, both in terms of the last big swing, closed above, closed below, and now finding resistance there again. So if it breaks resistance, it'll go up. Magic, I know, right? The slightly more aggressive entry, kind of more market structure based. We recently had a short-term lower low on the daily time frame, right? We had support at, I believe this is 10 point whatever, I think it's still about 10.6, 10.7 here. And we obviously made a lower low close. That's what I'm delineating here. Not the level, but the fact that we had a low close here, acts as support, and then on this ugly kind of engulfing candle, we made a lower low close. So market structure was broken on a much more granular level, I suppose. So what you could do is just to box out, again, the consolidation that occurred before the lower low close. So kind of the exercise we were doing on the lower time frames, that where is the box before a lower low or a higher high? In this case, this is the consolidation or the box before we made a lower low close. So that's resistance. We have some extra brownie points because we know that it's aligned with our quarterly levels, monthly opens, etc. So the long setup would be pretty much any break of that level would suggest strength, and that this price action here was kind of the failed breakout attempt, etc. And then long story short, something in a similar vein to this. So those are the two kind of bullish setups I'd want to take that are more momentum oriented or paying up for an entry. Red box break higher into, I think at that point, decent chance of a squeeze towards the weekly levels at 11. Or if you want to be slightly more conservative and granular, focusing on more recent price action, literally this daily candle here before the last lower low close. Again, low close, lower low, came from or preceded by this consolidation here. That's resistance. And if it does the same thing as in the bullish example on the intraday time frame, something like that, obviously that's my touchpad making predictions there. But those are the above market bullish scenarios I'd be interested in. Below market, in terms of swings, I'm not really convinced. I'm going to treat this as a range, the 10.3, 10.7, until proven otherwise, until at least one of those daily time frame setups materializes. If it's a question of dip buying, for me, even for intraday kind of punts to first trouble area, I think 10.3 would need to be reached. And simply because of how price spent, or how price looked the last time we were at the level. Normally when this type of thing happens, just observationally, where you get, support at the level, pretty unambiguous, right? You've got lows, and then it does this pattern where it closes below the level, technically bearish, and then completely engulfs it and basically runs away. Normally, that price, if it gravitates towards the area, it will come back and retest the level where it didn't spend much time, right? Close below, super bearish, engulfs the whole move, bullish move, but didn't spend much time at the level, unlike previous tests. And this is just anecdote / screen time speaking, but generally, and those of you who watched my YouTube kind of know what I'm talking about, when these double close patterns occur, close below, close above, it's still very valid support, and more often than not, will get tested if the market's still willing to entertain those range-bound conditions. Okay, I suppose if I were to just forget all my own levels and treat this as short-term chop, short-term range, I would simply do resistance at the pre-breakdown red box here, and support at the kind of higher low box here. And as you can see, no surprise at the very tight range we've had, because there are some pretty decent technical structures close to market. Both are still intact, and we're just chopping until proven otherwise. Let me just see if I've missed anything on the intraday time frames. Not particularly. Not in my opinion. And yeah, like the red box continuation scenario, right? The one on the daily time frame. How that looks on the intraday time frame is pretty straightforward. You've got a huge area at that level, right? 11K, whatever you want to call it. So I suppose the trade would essentially look like that daily idea on the intraday time frame is some oh my god, why are you so thick? Things to say on a Friday night, but some version of this. Again, this isn't a novel trade idea. This is just me transplanting the daily setup on the intraday time frame. As usual, too good to be true. It will very rarely look so clean that you're almost an idiot for missing the trade, but the whole point of these squiggly lines is to A, get the levels across, and B, signal which direction I want to trade a break towards. Anything more than that, how exactly the candle closes, how much time price spends at the level, etc., those are all things, unfortunately, as discretionary traders, or fortunately, we have to handle then and there in one form or another. Does that make sense so far? Ankit says, so what you're explaining are pivots. Sure, but look, the whole thing about price action is people take very similar technical structures, stuff that happens around higher highs and lower lows, and then they call them 50 different things to confuse you and make you feel undereducated, and then sell you a really expensive course explaining the same thing, just using their own language. Like, is it a range with a break in market structure? Is it an engulfed supply demand zone? Is it an order block? Is it a breaker? Is it a market structure shift? Or more importantly, the better question, does it bloody matter, right? And the answer is no. Trust me, don't trust me. Don't do that at all. I really hate using that language. But believe me, I suppose that's somewhat better. I've been down the price action rabbit hole where I've, looked into all of those methods and tried to figure out every bit of price action, teaching, education, etc. And I've also traded alongside and with some really fantastic price action guys from a number of disciplines. The supply demand guys and order block guys and range guys. And the one thing I've discovered is that more often than not, the patterns that people follow are virtually the same, and the levels that people land at, certainly on high time frames, are virtually the same. The edge comes in actual trade management, comes in trade execution, position sizing, knowing when to hold a winner or when to cut a loser early. Like, it's all those really nitty-gritty things that make up an edge when it comes to price action trading, as opposed to just, here's my box, and just because I know how to draw this box, that's what's going to make me profitable. Trust me. God damn it, I said it again. Don't trust me, but it is my personal experience that is not what matters, right? That is what matters. You can give 10 good price action traders the same chart who trade on the surface different things, like, oh, I'm supply demand, oh, I'm ranges, oh, I'm support resistance, oh, I'm market structure, oh, I'm order block, etc. And then you look at all their charts, and more often than not, they'll land at the very similar areas. Okay, but that doesn't mean their trades and their actual trading is the same. Lauren to you says, I don't trust you. You definitely shouldn't. You definitely shouldn't. I'm going to restart Light Shot because that thing was dummy thick. Hold up. Okay, hopefully that's fixed it. Someone asked about the bearish scenario. Let me see. What was I going to say on the daily time frame? Yeah, I mean, for me, the bearish scenario is more or less now, doesn't mean I'm selling this, but purely in terms of what we've discussed, of price being still range bound and at resistance, it would have to be price finding resistance at 10.7, right? We had, and again, I was wrong here, whereas my argument was we had the close above the level, which failed. If it closes above the level again, it technically shouldn't fail, and that's probably going to lead to bullish continuation. But then we got the whole BitMEX, Arthur Hayes, whatever shenanigans, and so the technical setup did not play out, and it did end up being a double fake. So for me, until proven otherwise, resistance in around 10.7, nearest support on a high time frame basis closer to 10.3, and until that range breaks decisively, at least on the daily time frame, I'm just going to continue treating it as chop and taking intraday level to level whatever stuff, internet and sister's house laptop setup permitting. Just to recap, the bullish one would be this green candle basically failing, to simplify it as much as I can. I don't know why I did that. Here you go. This is the lowest close, highest close before a lower low. That's resistance. So if its top boundary fails and we get a breakout, I believe we'll trade higher into this swing high at least, but then likely tag weekly levels. So that's the bullish scenario. That's bullish scenario 1. Bullish scenario 2 would be a dip back to support. I think there'll be some sort of intraday bounce to be played if we get back to 10.3. Right? The bearish scenario, intraday basis, any big rallies or deep spikes into 10.7, 10.8, for me, that's still resistance, treating that as a range, or failure at 10.3, which for me would suggest higher time frame unwinding. Again, you'll recognize that I'm quite reluctant to say scenario 1, scenario 2, scenario 3, scenario 4. If it does this, if it's bullish, if it does all of this, it's bearish. Because what you essentially end up doing is a whole lot of nothing, right? You try to account for every single scenario so you have a trading plan no matter what happens. I think on paper that's really good, that you should be ready to trade both sides of a market, but it's good for preparation, but often it's far less straightforward in execution. Like, you can have a bullish plan, bearish plan, and take whatever happens. Like, people tweet that all the time. And again, I've seen very few traders, Trader SZ being one of them, who can actually trade like that. More often than not, it's kind of like the Mike Tyson thing, right? Everyone's got a plan until they get punched in the face. You can set yourself guidelines and the type of business you want to do at levels. But as a discretionary trader, sometimes price will form in such a way at these levels that I don't want to buy it, or I don't want to sell it, or I want to wait for something else, right? That's why I'm reluctant to basically sit here, occupy an hour of your time and just draw shit like this all day. If it does this, long it. If it does this, short it. If it does this, long it. If it does this, short it. I mean, what the fuck are we actually doing here? What a colossal waste of time and an insult to your intelligence if I were to sit here and do that, which is why I'm reluctant to sort of just shit out a whole bunch of plans and call it a wrap after an hour. It's just not a very good use of our time, in my view. I think people need to recognize that SZ is the exception to the rule, right? Like, his style of being very neutral at a lot of levels and just say, this is the trigger for this is the trigger for that, and then actually acting on it, that's very unique, and most people can't and won't trade like that. So it's very hard to try to emulate that, and I haven't seen it done with great success, with the exception of him and a few others, right? I think it's a good approach generally to not be married to a side of a market and be ready to play both sides. But the thing about SZ is he will take entries that you're uncomfortable with because he'll know where his invalidation is, and he'll also know where his target is. So his entry in his system, I risk being wrong here, but my understanding is the actual entry is far less important than invalidation and target. So for example, let's say that this 10.7 whatever is a huge level, and he has a squiggly line which essentially says, if you get like a break in market structure, blah, 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 like you long it if it's bullish above 10.7, he won't give a shit if it breaks and he ends up buying, let's say 11.1, 11.2, with an invalidation at like 10.5 and the target, let's say 11.5, right? Like, he won't care that his entry is far away from the level and he can stomach a retest if it comes back, etc., because he knows that he's got a high probability target and a very clear invalidation. An entry really doesn't matter. Most traders that I know, and this is to some extent true in my system as well, I generally won't be terribly comfortable doing business far away from a level if I can avoid it. Okay? So what you'll see is people kind of trapped in the middle of those and end up making no good trades at all because their plans are kind of break this level, goes here, breaks that level, goes here. But when price actually breaks the level, they're like, oh, well, it kind of closed far away from it. Maybe I should wait for a retest, or maybe this is the deviation and blah, blah, blah. And they just don't have the executional edge that he has and the executional discipline to actually take the idea at an uncomfortable level at an uncomfortable entry and then basically ride it out to invalidation or target, right? So that's an important point and distinction to make, in my opinion. Let's talk about ETH. If you have any questions about Bitcoin, let me know. I know we dabbled in some educational stuff there as well, so if any questions about any of that, or if you don't want to see that kind of stuff or do want to see more of it, I'd appreciate some feedback on the attempted teaching. ETH monthly close is kind of dog shit. It puts me at a rough spot in the market generally, and I think listening to the Casual Friday episode is really good because we kind of talk about the macro to some extent. So Bitcoin's monthly is positive, right? Any close above 10.3 would be okay. Any close above 10.7 would be good, and we close above 10.7. So the monthly looks good, right? The ETH monthly looks dog shit, in my opinion, at the moment. Why? Well, because we have this area at about 390, 400, really big support resistance flip. But what did we have? We had a close above the level. Yay, that's really bullish. Send it to 500. But then we had a close below the level. So we got a fake out, right? A bearish fake out, or is it a bullish fake out if bulls eat shit? I don't know. Whatever. A bearish pattern at monthly resistance. And those of you who've watched the YouTube video on clean double close, strongly recommend it. It's still a setup I trade all the bloody time. The monthly close on ETH is bearish because it's essentially a failed breakout. Close above the level, great. Close below the level, shit, it was a fake out. So we've essentially had a failed breakout at amazing monthly resistance / one of the best levels on the chart. So purely looking at this, my first instinct, whatever that's worth, is something like the following. Rally back into that level and then pull back to first trouble area at 300. That's just what the monthly close is telling me. Okay, so that's the monthly, not great, and they would need to break some levels, which we're going to talk about now, in order to recuperate. Now, the levels that it has to break are reasonably straightforward, I think. Well, it's never straightforward. It's always straightforward on the chart, but trading it is never as straightforward. Like, a good example of that, I remember when 6K broke down on Bitcoin for the first time, my view was, well, look, it might dip quickly and get bought back up. It might range for 2-3 years at like $2,000 and then eventually break back up. Why? You know, certainly if you're going for some sort of macro allocation or high time frame, risk on, risk off, gauging, etc., why would you try to knife catch below 6K for an indeterminate period of time if you can just buy above 6K and have a much easier ride out of it, right? And that's exactly how the market played out. So sometimes, and again, I would strongly recommend, pause what you're doing, click the description, TechnicalRoundup.com. It's a free weekly newsletter. We talk about this stuff all the time, and especially if you're trading lower time frames and higher time frames, it just helps you keep a pulse on the levels that matter. But the basic point is that sometimes the market gives you really, really nice levels whose break, one way or another, leads to some pretty significant trending moves and has broad implications for the market. That last point is very important. Not all levels are made equal. Some levels carry greater implications for the market as a whole than others, right? Like 6K for Bitcoin was more important than, say, 8K for Bitcoin. So accordingly, the break of 6K means more than the break of 8K and leads to more decisions, etc., etc. So for ETH, I think there's that's wrong. There's a similar argument that can be made. There are a couple of areas I want to bring your attention to. One is this weekly / monthly resistance, which falls anywhere between 370 to 390 or kind of 380 to 390. We can pretty much use just this candle here. I think that's what's got Donald's got. And this really shows that monthly fake out that we talked about really clearly, right? We had huge level here, okay? And we also know it's not just weekly, it's also monthly, and all the high time frames align, etc. We could even take some liberties and draw it from the wick to the open, something like this, okay? You could say it's curve fitting, but again, when you're dealing with really big areas, it really doesn't matter. But basically, resistance broke above the level. The market should have been bullish, right? One of the best technical levels on the chart has been broken. If there's ever an excuse for momentum continuation north, that was it. What did we get instead? Like, even just looking at this chart, what's the event or the structure that stands out the most and is probably the most significant? It's this fucking engulfing candle here, right? I didn't see how it could be anything else. Even if you just look at its relative size compared to the next month of trading, it's basically a ton of very wealthy people. I don't mean to go conspiracy theory here, but look, a large chunk of positioning was exchanged / established on this trading week here, and after that move, fuck all has happened. That was essentially the climax, if you will, of the market, and it was to the downside in one of the most bearish weekly candles you can kind of come up with, right? Why? Well, because it spiked above the entire range of the preceding weeks, right? And then it spiked above the top of all the preceding weeks. So anyone who had kind of trend following, breakout buy systems ended up eating shit. And then on the close, it closed below the entire range, even if you use the lowest close by some metric as well, right here. And after that, right, so you get this selling climax. Oh my God, breakout, send it to 500, etc. Insane volatility, market eats shit, probably one of the uglier weekly candles in recent price action, and since then, absolutely nothing, no real bloody interest in this thing. So the prevailing bias, or the high time frame bias, now we've looked at the monthly, which shows a high time frame fake out, and we're looking at the weekly time frame through a similar lens, or this same kind of area. It shows a similar story, as it should, that you got a temporary break above this key level, every excuse in the market to rally into higher levels, and instead it eats shit with a huge engulfing, and then the market just vanishes and volatility falls off, right? Something I will keep re-emphasizing because it works. The best, like, if you want directional bias, really good bullish setups failing is bearish. Really good bearish setups failing is bullish. This is an example of the former, whereby you had pretty much the best support resistance flip you could ask for, the best bullish setup to send it higher, and it failed spectacularly, and fuck all has happened since then. Okay, so until this picture is resolved positively, so something like this, right? Again, I don't expect the chart to actually look like that, but just to give you an idea of the levels and the direction in which I'm looking to trade them, until something like that happens, or even, to be honest, being conservative, a break back above the top of the range, so kind of using the highest close, something like that, until I get evidence which shows me that this mega weekly engulfing, which was bearish and sucked all the volatility out of the market, until there's some evidence to mitigate that, my macro view is going to be bearish until proven otherwise, right? Now, that doesn't mean I'm going to market short. Why? Well, first of all, because that's not how I trade. But second of all, if we look at where the weekly candle structure is right now, there's been a notable absence of continuation to the downside, even after such a climax, right? Specifically, if we look at where the market's finding support right now, we had this insane bearish looking candle, etc. The market's basically gone nowhere for a month, and it's actually finding support at the lowest close, at the close of that month as well. So that's support. Something like this, support on the lowest close, and resistance, the top of the range, on the bottom of the previous range. That's kind of where I've got Ethereum capped for the time being. Okay, and now if we add my levels, you can see that it essentially aligns. I'm even going to add this level now while I'm here. What am I going to call this? Engulfing close. There we go. Okay, and that's sort of how Ethereum looks at the moment. High time frames, rough. Monthly close, bearish. Weekly, climaxed in a sell-off and has basically done nothing since then. Lower time frames, similar low volatility conditions, but for basically chopping around weekly support at 352. I think generally trading plans are less clear for ETH around current levels, and it's really above and below market where I want to do business. This is all chop. So what I mean by above and below market is where I want to do business. This is that magic red box we talked about, which should have been support but failed spectacularly. And you can see it's acting as resistance. So if I wanted to be bullish, I would need this to fail, right? Break, etc., trade higher. Or ideally, as I said, nothing wrong with paying up for an entry through the top of the range, right? Above 420, 430 higher. I think that's absolutely fine. And at that point, that ugly high time frame picture will have been mitigated to some extent. That said, bullish kind of downside scenario would be at support, right? We know that the monthly time frame faked out and closed like a piece of shit. Also know that monthly support is in this 280, 290 area. So if it dips there, at least for an intraday bounce, I think there is a play to be made at that stage. But where the market is right now, the two levels that I want to do business, a break of resistance to trade higher at around 400 or a dip to support at around 290, 270. Anything in between is kind of anyone's guess. We can speculate on some intraday setups. The two that kind of come to mind are the following. And again, they are much lower conviction than anything else. The bearish continuation setup would be something like this. Whereas the market found support recently, it was this cluster here. And we know that 290, 270 is, I mean, arguably a magnet for price. That term is somewhat ambiguous. What I essentially mean when I say it is if the market starts moving in this direction, then this is where I'd expect price to settle sooner rather than later, right? So if you get a break of support at around 320, which is where the last low was formed, again, never going to look like this, but just as a rough roadmap, I'd look to sell resistance in this area to take me to the promised land of 270, 290. That's kind of the bearish continuation scenario. In terms of selling rallies, I think it's slightly more tricky because while we know that monthly resistance, we had this whole bearish monthly fake out, etc. at 370, 390, even looking on the daily time frame, it's not exactly the freshest level in the shop, right? Before we had this lower low close or this most recent leg down, you can see after breaking the structure, right? Because it was acting as support the whole way. Once it was finally broken, we've already had a number of retests at the structure. We had one kind of on the way down here. Whether you want to count that or not, I think it's down to preference. We certainly had one swing number one, swing number two, and then a third push would be the third test of that level as well. Still valid resistance. I think the monthly close, if anything, has given more weight to this red box being resistance. But if I were to sell this level, what I'd need to see, because we've kind of tested it twice and put in some relatively equal highs at the structure itself, if I were looking to sell anywhere close to 400, I would need a push, not into the lower boundary at 378. I'd need a push that takes out those highs, spikes more comfortably into 400, and then I'd look to sell that into FTA at 378, and then see if 378 breaks. There's a good chance that that was the kind of final bearish retest before unwinding lower. But that's an important technical point. For the most part, when I draw these boxes, I'm not just drawing a box. They are often comprised of levels, in this case, a monthly level and a weekly level. And if we rally from the 350s and put in a leg higher, I don't want to do business at the lower boundary. I'd rather do business at the upper boundary for ETH. Let me have a quick check on the intraday timeframes, see if anything kind of jumps out at me. If not, then not. Yeah, I mean, you can kind of see that even this... I mean, we're at resistance right now, similar to Bitcoin. Bitcoin is at the top of the range at around 10.7. I think it could go higher and spike that area, but I don't have any strong views. I'm not planning to trade how it looks right now. ETH is kind of looking similar. We've rallied into resistance, which is made up of an intraday level at 357 and this engulfing weekly kind of lowest close we talked about as well. And that's sort of where the market is right now. Is there anything else? I don't think so. Oh, this is a good example. Is this a good example? Not really. I was going to say this is like arguably a decent example of the kind of market structure break concept. It's not the cleanest in the world, but you can kind of see a similar theme whereby you had bearish continuation, right? Leg down, consolidation, another bearish leg down, continuation, right? Where was market structure kind of rebroken or broken again? With it after the or within this consolidation, lowest close, highest close, should have been resistance, wasn't, short-term support, short-term support. So again, filtering for levels that occur around market structure breaks is a pretty decent idea overall, in my opinion. And you can kind of see the same with where these, and again, all of this shit tends to align with high time frame levels. Even if we take this high, excuse me, even if we take this recent high relative to this high, it's technically a break in structure. Again, some will argue that it needs to be kind of a low, higher low before a higher high, etc. Like, I don't think market structure is a science necessarily. I've seen contrasting and varying approaches and blah, blah, blah. They all work and let's all be happy and live together. But even if you use it on a high or closing basis, market structure was broken here, right, by this impulse leg. So again, working backwards, where is the range or the consolidation which preceded that higher high? And we're left with, sorry, that was the 4 hour, my bad. And we're left with this structure here. Lowest close, highest close before the higher high. Should have been support, failed, and now acting as technical resistance. Let me see if I can do it. I just want to type this out. Consolidation, range, box that precedes higher high but fails to act as support is good resistance directional bias box. Consolidation, range, box that precedes lower low, but fails to act as resistance is good support / directional bias box. I'm going to leave that up for like 10 seconds or whatever. You can screenshot it. Maybe it'll make sense. Maybe it won't. I'm happy to do a session on this, maybe a separate live stream just covering this concept as a way of filtering for levels and doing business around market structure breaks. But hopefully that's a reasonably comprehensible and intelligible summary after those examples we talked about. And the logic is straightforward, right? A higher high should be pretty bullish. If a higher high fails, that's bearish, basically. Same here. A lower low is technically bearish. If it fails to act as resistance, a bearish setup failing is bullish. Please tell me there's one person in the chat to whom that makes sense. And if it does and that you learned something, you know which buttons to hit on the video, blah, blah, blah. Hi, George. How are you doing, mate? Nice to see you. Hope you're enjoying your comments section. Everyone telling you you're going to be wrecked, etc. Of course it makes sense to George. Bloody hell. Makes sense? Okay, look, it's not something you necessarily have to understand on the very first go, but hopefully I've made it, at least you know where to look, right? Great explanation. Thank you, thank you. Very kind of you. Someone asked about ETH BTC. I don't have any informed views on ETH BTC. Oh, here's another example. Look at that. Specifically, it's not just higher highs. I mean, yes, that is the kind of market structure break, but we want to look for impulse legs, like really clear breaks in market structure. So, like this leg here, right? Boom. Clears out these highs, break in structure. Where is the range, or the highest close, lowest close that came before it? Highest close, lowest close that came before it. Breaks higher. Wow, market's bullish, should be support. Eats shit, now finds resistance. Yes? Yes, no, maybe rain, maybe snow. Yeah, as to the technicals of ETH BTC, for me, it's just still moving sideways, and there's nothing terribly clear for me here. The levels, the high time frame levels are still intact. Oh, this is a good example of that double close thing I talked about. Hopefully, I can explain it here. Resistance intact, kind of poking around top of the range, no acceptance. Support as well, got reclaimed. Nothing really else there. In terms of short-term technicals, I've got this lowest close as a level of resistance. which it's currently acting as. But there was a point on the Bitcoin chart where I said that if you get a close below, close above at support, and price flies away from the level, it'll often come back and test it. Same at resistance. If you get a kind of close above, close below, and the market just flies away from it, it'll often come back and test it. So this is an example of what I mean in Bitcoin, right? Sorry, ETH BTC. You've got support, support, close below, and then the next candle closes above and runs without retesting the original level itself. It's still valid support and will often come back and be retested. That's sort of what I mean. But yeah, ETH BTC, I wish I had something more interesting to say, but I don't, right? I don't. Until I get a high time frame break of one of these levels, I'm just going to assume range bound, chop, etc., etc. That's all I've got. That's all I've got for this week. Sticking to the big ones. I will make next live stream more altcoin oriented, so we can kind of catch up. I know Donald is really good with the altcoins, so I'll kind of give that domain over to him to some extent as well. Final thing, YFI, USD. I think the BTC pair looks similar. Very popular charts on Twitter, so I guess as someone who's never traded this, I'll give my 2 cents, whatever they're worth. Wow, this touchpad is not making my life easy. Yeah, so for this instrument, I think a couple of levels are really good. One is this lowest close here as the bottom of the range / support. That's your kind of directional bias level. That's the bottom of the range for me. This is roughly the top of the range. And then anything kind of within here, highest close, lowest close, is support. Arguably, you could tailor it to this box here, in which case we've already hit support, blah, blah, blah. But these are the levels that really matter for me. Let me even just draw these as levels so it's not confusing, now that you know where they come from. Highest close, lowest close. So with where this is right now, it's technically bearish because it's broken the range. The bullish setup would be, surprise, surprise, close back within the range, move towards the range midpoint, and then the top of the range. Until proven otherwise, I'm expecting it to find resistance at the lower boundary and head home towards support here. But right now, this is one of those shitty areas to trade unless you're loom dart and scalping like an absolute phenom on lower time frames. But certainly from a high time frame view, it's not ideal at the moment because it's not retesting resistance where you could look for risk-defined sells, and it's also not at support where you can play short-term bounces or whatever else. It's just in between levels. So this is, in my view, where you wait for it to reach something that's a bit more structurally robust, for lack of a better term. Whew. Right, that's all from me. Any final questions, comments, concerns? I saw just the likes just jumped by 10. Thank you very much for your support. And again, so grateful for over 10,000 subscribers. You guys are fantastic, and we've very much enjoyed having these sessions for you. So, very appreciative of that. Final notes. Thank you to Bybit for sponsoring Technical Roundup. They've got some new features on the platform with their new take profit and stop loss system. Makes things easier. Link in the description to check it out. Thank you to them for helping us out. The newsletter, Technical Roundup, comes out tomorrow. Some really good stuff there. We'll probably repost our kind of macro view with like Bitcoin, ETH, equities, a few different scenarios to be aware of. So make sure to subscribe. That's also free. Also, thank you to Bybit. Like the video, do all that fun stuff. It's been great chatting with you, and we'll see you in text format on Tuesday. You've got Donald on Wednesday, and on Friday we'll try to come up with something interesting. Final note, watch the Gainsey episode, the most recent Casual Friday. If you haven't already, I guarantee you will learn something, and it's a really good lesson. That's all from me. Let's pray I get internet this week, so on Monday I can be at home. But for now, take care and have a safe and productive weekend. Weekend? It's Monday. Whatever. I'm stopping the live stream. Goodbye.